Well, I guess I'm the smallest on the stage. So they've got B's next to their numbers. I've got an M. So we're about 170 million.
Right.
So what we're looking for is because we're looking at narrow slices, that makes sense because we can go into fairly large sectors and then take a small slice of the most interesting, and we call it sort of, the parts of the market that are difficult to source, difficult to assess, and also difficult to monitor after investment. So we can do that because we're really picking and choosing where we are in the market. We don't have to be broad. At the same time, we're quarterly liquidity. So we have to manage how we invest across the portfolio. We have a much smaller part of our portfolio, maybe at max 20%, which is a little bit less liquid. So maybe it's locked up for about 2 years, but it tends to be income producing, so it's amortizing along the way. So, and then we sort of manage our liquidity from there. So it is really important for us. So size is really important for us in the sense that we are, as a smaller investor, we're looking for small niches that particularly larger investors that have the B's next to their numbers they have too much capital to put into one of those niches. They would overwhelm them,
right.
And they would influence prices. They would influence leasing rates. They would influence coupons that they're getting on the bonds. So we come in and create a diversified portfolio of those kind of 15 of those kind of investments and put them in a portfolio, and that tends to act as a diversifier to the broader strategies like equity.